I suppose it's been a topic that I've been thinking about a lot. And ever since we launched CRIISP, I've really been trying to sort of contextualize how, I suppose, how we see the future of capital raising, but more than that, why we see that. And it really goes back to, I suppose, how we're thinking about the capital raising process and the people that we deal with. And it only sort of occurred to me, we were sort of having a team discussion. One of our team members talked about, he sort of threw out the idea that really we're sort of talking about capital raising in its sort of third iteration. And so I started thinking, really sort of going deep into it. I thought, okay, well, how about I do a webinar to help sort of understand what we see as the future of capital raising, where it's actually come from, where it's going to, and the reasons behind that. Because I think it makes a big difference, and it really start to change the way people are thinking. Because in our sort of day-to-day interactions, whether it be with advisors, investors, or with companies, we find that most people are frustrated, but they can't really quite, I suppose, specify as to why. So they just know it's not the most efficient process. But we've sort of done our best to try and understand that and trying to sort of, I suppose, solve that in the way we're thinking about the CRIISP software platform. So the first step is to really, I suppose, help understand what is, as a starting point, what is capital raising 1.0? And if you were to really think about it, capital raising 1.0 is actually driven by personal networks. And in those personal networks, in this, we use a sort of image, and it's one of my favorite images of JP Morgan and also Thomas Edison, because it was driven around personal networks. And if you think about the investment bankers, the corporate finance houses, they effectively survive off the mandate fees, but where they thrive is off the success fees connected to companies. But the actual introductions to investors for deal flow is typically their personal networks. And those personal networks typically come from either family, it comes from friends, or it often comes from university networks as well. And so as we speak to founders, some of them feel like this sort of whole capital raising area is a bit of a dark art that they don't sort of quite understand. And, when we looked at that sort of capital raising 1.0, and it's sort of in our thinking, not much has actually really changed from that. In fact, most of capital raising is driven by personal networks. The only two additions that have been added to that has been the addition of email sort of in the 90s, and then also Excel spreadsheet. And the amazing thing is when you speak to a lot of investment bankers, you speak to a lot of corporate finance houses, that's actually still how they're driving their deal flow. So really, the capital raising 1.0 is actually being used by most of the sort of well-known brands that you sort of think about from capital raising. So it's not as much money has gone into all different sort of areas of technology and disruption and everything like that. It's all still being driven off personal networks, Excel spreadsheet, and email, which still amazes me. And then we sort of look at capital raising 2.0, and 2.0 sort of does recognize the potential of the internet. And what we've seen is that a lot of advisors or people with a sort of advisory background and experience have gone and they've set up a website, and then they've overlaid their advisory skill to that. So I thought, what we can do? We can actually get these deals, call it a platform, but really effectively what they're setting up is basically what is the so-called platform is actually just advisory with a website. Because they still have to structure the deals, they still have to get involved, they still have to prepare them, they still have to run the typical capital raising process. So it's actually really not that much different. And under that banner also comes equity crowdfunding, but there's platforms that do it with just high net worths, and there's also some that do it with equity crowdfunding as well. And some of those do charge an upfront fee, and they're also charging a success fee. The other part to it is that there's been obviously new services like Dropbox, Google Drive, and also a lot of virtual data room services as well that have come to the table. And people have been comfortable in using that. And what's really interesting is that to me reflects what capital raising 2.0 looks like. So if we think about capital raising 3.0, it has to look very different to what capital raising 1.0 and 2.0. And so I suppose we had to look at what other disruptions were happening in the ecosystem, what other things were happening in the marketplace. But also we had to understand what is the common information in the marketplace as well. And this is where we sort of stumbled across some of the common myths that we actually encounter in our day-to-day work with companies and with founders. And the first one is, and this is what I absolutely love, and we've had this question a lot with Chris, well, if it only takes 2 to 3 months to raise money, so what are people going to do the rest of the time? And this is absolutely insane to think that. We've done now workshops across Australia, Singapore, and also the UK. And less than 5% of people have completed a full capital raise within a 2 to 3 month period. I mean, start to finish. But yet it's just such a common belief. And in fact, I've heard it from shareholders in businesses. I've heard it from advisory boards. They put the pressure on the founders to get a capital raising done in this time frame because they're concerned about how the deal will look if they don't. The reality is it just takes far longer than that. So that's the first myth when it comes to raising capital. It will take 6 to 12 months to get that capital raising completely done from start to finish. And in fact, even when people look like they've finished a capital raising in 2 to 3 months, often they've done 5 to 6 months of preparatory work, or they've been working with that investor for a period of time. So there's a fair bit of like, trust, respect. There's been a fair amount of due diligence done beforehand, but the way in which they've done the timing, it makes it look like that. So that's the first myth we want to sort of smash. The second one is that that companies and advisors are using analytics, and this one has absolutely amazed me. For me, I've got a marketing background, and I love anything to do with data and analytics because it helps you in understanding what is actually going on. It gives you a feel for what's actually happening. And it's amazing to see that less than 20% of advisors or companies are actually using any analytics whatsoever for their capital raise. So this means companies and also advisor groups are effectively sending out IMs out to potential investors, and they have no visibility over that interest whatsoever. What's been amazing for me is ever since I've launched CRIISP is I've been able to obviously track what happens in my deal room. And it helps me understand the engagement of potential investors with the deal room. It also helps me understand what questions are most important, etc. And with that, I said, I get to understand a lot more about my deal. And I've always been a big believer that the more analytics, the more information you have, the more you can tailor that information, the more you can understand what is most important to potential investors. And the last one, this one astonishes me the most. And when people think that VCs are the main investors in this space, when it's very well documented that VCs will invest in less than 1 in 100 companies that they meet. So the question I have for everyone is, well, how are the other 99 being funded? Where are they actually getting that funding from? What the truth is the majority of this space is actually driven by the personal networks, yes, and it's also driven by high net worths. Right, especially in Australia, especially in the private capital raising space. So whilst people are trying to gear up all different areas to specifically target the VCs, they actually don't represent the majority investors in this area. And in fact, it's the high net worth that drive this space, and the industry itself. The industry invests a lot back into its own ecosystem. So the amount of corporate advisors, lawyers, accountants, etc., that we meet that work in this space, the reason they work in this space is they're often passionate about it. Secondly, they typically hold investments in this area as well. So they're the three things that we sort of encounter on a daily basis. And so when we started thinking about what does capital raising 3.0 look like, we still then looked at, okay, let's isolate what the main problems are. The first one is the actual investor attraction and discovery process is endlessly frustrating for everyone, for both companies and also advisors, right? The money and time that is wasted, right? Because there's effectively no integration. There's a lot of manual processes. There's no analytics. There's no defined processes specifically for companies, etc. It is frustrating. It's redundant time, right? It's opportunity cost time. So that fragmented ecosystem, the manual processes, the no funding, the lack of investor connectivity, the no analytics, and the other one is there's using isolated and legacy systems. Right. The one that really amazes me the most as far as the biggest, I suppose a frustration point is that online platforms are charging 6 to 8% for capital raising. This makes absolutely no sense to me whatsoever, right? Given that it's an online introduction and knowing how much work corporate advisors will put into a deal and how they structure it, how they present it, how they pitch it, etc. So that one's never made sense to me. And they're the typical problems that we're seeing in the marketplace. So effectively, you've got a frustrated ecosystem from both the companies, the investors, and the advisors' perspective, and you've got $1 billion opportunity that is there to be sold, and that opportunity is the inefficient private capital markets. No one in the last 10 years has come to me and said, "Look, we absolutely love the capital raising process, and we think it's efficient." And the nice thing is there's a common belief that software could play a role in it, and the reason is because there's been so much money invested into software to help improve efficiencies in other sectors. but no one's really done it for the capital raising area. I said minus that success fee component. And the other part is that the current platforms trying to target this area, they're actually trying to compete with their ecosystem rather than enable it. So from our perspective, we've looked at capital raising 3.0 and we thought, okay, we have to take a platform and a marketplace approach to this. And the software, its job is to lead the role in the investor aggregation part. And obviously, we've been fortunate enough to do that with Wholesale Investor. We also have looked at it and thought, well, the model has to be subscription-based, secondly. The deal making can be driven by AI, right? There needs to be frictionless engagement. There needs to be efficient transaction. There needs to be some sort of trust element to it. There needs to be some sort of potential for liquidity. But more than that, for the existing ecosystem, it has to be a tool which, when they use it, they believe they can create more opportunities and make more money using that tool rather than it taking away. And so when I look at capital raising 3.0, it really does learn from the most successful technology platforms and marketplaces that it's actually been invested into. It understands, and this is the other thing as well, is that no one actually really owns investors. I said, even though Wholesale Investor has a large database, we don't own those investors. Those investors are looking at other places for deals as well. We just happen to be one of those places. So we thought, well, then the marketplace must have to have some sort of aggregation as well. Because if you do that, then what you can do is with that aggregation, you can be much more effective at providing deal flow, which is relevant to those investors, but not even just relevant, that they can actually add value to. So it's moving from just about raising capital to, okay, how can a platform, how can a system matchmake effectively with an investor opportunities in which they can obviously invest into, but add value to, contribute networks, contribute time, etc. Because what we've noticed is that in this space, more and more investors are looking to be active with their investments. Okay, so there's some of the key areas that we've been thinking about. And when we thought about the CRIISP solution, a couple of things we thought about is firstly, it needs to be software driven, right? And obviously that's why CRIISP is like that. It needs to be ecosystem enabled. It needs to be end to end. The investors do need to be aggregated. It needs to have AI driven matchmaking. And the reason being is because what someone says they're interested in can often be quite different to what they're actually interested in, down the track, or what they're registering interested in, or what they actually invest into. So that combination of what they say they're looking at, what they're really looking at, and then what they invest into. And if you can actually bring that data together, you can actually become a lot more effective in the way in which you matchmake. Now, from an ecosystem perspective, this platform needs to enable companies, it needs to enable investors, it needs to enable industry. It has to save them time, it has to save them money, and it has to improve the efficiency in which they operate. Now, the next part that's really important as well is, especially given the amount of low IPOs at the moment, it needs to provide some sort of liquidity potential for those companies. So these are all the different aspects that we've thought about in building the CRIISP platform. And more than that, we know that when we do it, when we're thinking about this, it has to have an ecosystem approach, right? So whether it be the other startup platforms and ecosystems, whether it be conferences, whether it be investment groups, whether it be government are one of the big operators in this area, and they work with literally hundreds and thousands of startups every single year. Whether they be taking delegations overseas or working with them locally, they're working hard to actually give promotion whatsoever. So everything we've thought about is how we can engage the investment groups, governments, incubators, accelerators. People are already sort of operating in this space because it's got to be ecosystem led. And that ecosystem has to be provided with the platform, the tools to actually connect with each other. Now, obviously, from a wholesale investor perspective, we're actually really fortunate enough that we do have, we've built our own ecosystem over the last 10, 11 years. And the job for us is then how do we integrate the data that we already have with the data that we're about to receive, and then how do we effectively matchmake investors with that? So look, I suppose the way we've sort of thought about it is the outcome we want to get to is we want to get to subscription-based deal making, where starting at sort of $200 or basically $2,400 a year, going up to as much as $6,000. How can we help the ecosystem matchmake each other, considering that they would probably pay that in just a mandate fee alone? So the first step for us is the way we've looked at it is the capital raising admin solution. The second step is the algorithmic matchmaking. Third step is, how do we make the transaction as efficient as possible? We know that on one side of the coin, we're dealing with deal flow, and on the other side of the coin, we're actually dealing with the investors. And more importantly than that is, how do we then set up the platform so that if you're a startup, you can work with us right through to exit? And the important thing is that, because then you've got the data. If you're a startup now and you're thinking your exit time will be 3 to 7 years from now, how much would you love to be able to have the data and the interaction from potential investors, existing investors, and so forth that entire time? That is what we're thinking about it, because if you can have that data, you can understand the engagement levels of different people at different times. You can communicate effectively with potential investors. I said the platform then becomes your investor relations tool so that you can keep investors up to date with what your habits are. But more than that, even if you're not raising money, you may have investors that want to come into the business. So the role of the platform is to then help facilitate that transaction between you as a company and also you as an investor. So they're all the different things that we've thought about it from a CRIISP side. And there's plenty of examples, which we can provide in our sort of template of what the actual platform looks like. But to finish to summarize this whole sort of conversation, the way we look at capital raising going forward, it needs to be ecosystem driven, right? Because you've got to have the different parties. It has to be software driven as well. The ecosystem must be enabled. Said the end-to-end solution must be intact. And on the investor side, we want to work harder to actually aggregate that, because the more we can bring investors into our world, how we can become much more effective at actually matchmaking them with relevant opportunities. And then obviously along with that, you start to track more opportunities. Said AI must play a role. I said, because the importance of that is the system has to learn what your habits are and what investors are looking to invest into, right? No different to how Netflix learns what your habits are for viewing. The platform must have to learn your habits of what you like, what you're looking at and what you're investing into. And sometimes those habits change over time. And lastly, there needs to be detailed analytics to help understand what is going on. I said the platform needs to get to a stage where it can predict a transaction based on someone's habits. I said, and that's what we're working towards endlessly. So from our perspective, that's what we see as the future of capital raising and deal making. We see it as seamless. We see it as integrated. We see it as end-to-end. And it's got to the role of the platform, it's got to remove friction for the investors, for the companies, and also for the service providers that are working in this space. So I hope that was a useful but short presentation, but I hope it makes sense as far as what you're going to see is in the next iteration of capital raising platforms coming forth. And obviously we expect to lead the charge with what we're doing with CRIISP. If you'd like any more information, please contact us via the website, or you can obviously email us directly. Thank you.